Today we're going to look at bounce back loans and how they can, in certain circumstances, become taxable. If you're new to the channel, please consider subscribing, and it really helps me if you press the like button. So how can bounce back loans become taxable? Well, it really kicks in if you use your bounce back loan to subsidise your personal expenditure. Now you say, no, we're keeping the money in the company. Well, there are two main ways where it can become personal expenditure. So one of them is if you simply take the bounce back loan and use it privately. You know, if you use it to do a buy-to-let or something like that. Now, I'm not suggesting that is a good idea. I'm not sure that it's in line with the rules. But if you did that, taking money out of your company does become a taxable event. But I think more subtly, if you use the money to subsidise your personal expenditure during the shutdown, then it can become taxable. And I want to look at that in more detail. Now, bounce back loans, of course, bounce back loans are great. Small businesses are looking at bounce back loans, and why wouldn't you? Because they're so easy to apply for. Mine took 7 minutes to apply for, and it came into my bank account the next working day. There's no repayments in the first year. There's no interest in the first year. The interest in years 2 to 5 is 2.5%, really low. And there's no guarantee, no personal guarantees, and no security. So all of that is a really good mix of combinations. It's the easiest and perhaps cheapest loan you can get. However, the trap, as I see it, is where people take the money out to subsidise their private expenditure. And we all know, as small business owners and contractors, we know that our business finances and our personal finances are very closely linked. And that's the worry. So I'm going to go through it in some detail. Now, in order to do that, I have to mention a bit of tax law. So it's called Section 455. So Section 455, it sounds scary, it's not, and it is simple. What it says is that if your company lends you money, then you have to pay it back within 9 months of your year end. If you don't pay it back within 9 months of year end, you have to pay a 32.5% tax on it, and it's a company tax that you have to pay. And that's my concern, that the bounce back loans might creep into people's personal accounts and then trigger a Section 455 tax in the company. I'll go to detail on how that works in just a minute. But first of all, I want to just sort of highlight the people who are not affected. So if your company owes you money, then it's very unlikely to affect you, because it's only where you owe the company money that this really kicks in. And also, if your company has got substantial reserves, then you should be fine, because you can always pay dividends out of those reserves, subject to the finance of the business. So therefore, you should be okay. This really affects people with very low reserves, and where in particular they haven't lent money to the company. So I want to do this with a couple of spreadsheets. So let's look at the first spreadsheet. I always like to look at the spreadsheet. So the first spreadsheet is a profit and loss account of a simple micro business or a contractor. And here we've got a turnover of £100,000, costs of £40,000, which gives a profit of £60,000. Tax on that is a full £11,400 you have to pay. And then you pay yourself dividends of £4,000 a month, which is £48,000, and leave yourself a little bit of retained profit of just £600. So you've basically taken all the money out of the company. And that's a perfectly normal and reasonable, and often people do this. And then this has a corresponding balance sheet where there's some cash, some debtors. You can see there's a VAT, some corporation tax to pay, and you're left with a balance sheet with £1,000 of reserves. So that's completely normal. And it's sustainable in the long term. And then we had a year like this year. So moving on to the next profit and loss account, what I've done is include the base year as 2019 and then the new year as 2020. And here in this profit and loss account, you can see the turnover. We've had 3 months with no work, so the turnover has gone down from 100,000 to 75,000. Costs remain the same, so the profit is lower. It's gone from 60,000 to 35,000. The tax is lower because the profit's low, which is sort of a bad good thing. But importantly, the dividends have gone down from 48,000 to 28,000. Now, if you needed that £4,000 a month to pay the mortgage and to pay for food and pay for the car loan and all that sort of thing, then £28,000 is not going to do it. So in this example, the next sheet is the balance sheet that reflected this. So you've taken out your bounce back loan and you've basically used that bounce back loan to subsidise you to get your income up to the £4,000 a month that you need to pay your personal bills. But what it leaves in this balance sheet, you can see, you get a bounce back loan of 25,000 and it creates a director's loan account of 25,000 because you can't pay the dividends, because you can't pay dividends out of profits that you haven't made. So you've got a director's loan account, and director's loan account, so you are the company money, which is the problem that we were talking about when I talked about section 455. So what to do about it? What do you do about it? So, because it's all very well for me to tell you there's a problem. The problem isn't interesting. The solution is interesting. So first of all, be aware of it. So at the worst, if you're aware of it and you have to pay the tax, at least you know and you don't get a surprise tax bill. And section 455 is a peculiar thing because if in the next year you do pay off the director's loan, then you get back the section 455 money. So it's almost like a loan rather than a tax. It's sort of like a hybrid between a loan and a tax. So it's not the worst thing in the world, but it's not great because you have to pay the tax in the first place. And in this example, 32.5% of the 25,000 is £7,800. So it's not insubstantial tax. So first of all, you just pay it. Secondly, you could actually just save some of your bounce back loan for the section 455 if you know you're going to pay it, so you keep it on one side. Or, I mean, the other slightly more drastic version is that you just pay yourself a salary. So you clear the director's loan account with a salary. But if you pay yourself a salary, you are going to pay employers 13.8% national insurance and employees 12% national insurance. That's 25.8% tax, which is definitely not fun. On top of your income tax, definitely double not fun. So you might not want to do that. However, if you need to, that's what you got to do. If you've got to do it, you got to do it. So none of those solutions are fun. So I think the fun solution is to just know about it and then manage it, because we've got to your year end and then we've got another 9 months in order to sort this problem out if we have a problem. And I think just managing it through so that you can make sure that you don't have the section 455 in the first place is really important. And to do that, we need to really get a hold of your accounts and make sure that if you are subsidising your private drawings every month through the bounce back loan, we look at it because it's important. So, I suppose to summarise this, if you take your money out of your company, it's always a tax event. You can take your bounce back loan out and spend it on some investment, which you really shouldn't be doing. But if you did, I know a lot of people are doing it, that's why I'm saying it. So if you did that, that's fairly obviously a tax event. If you subsidise your personal expenditure through the bounce back loan, then that can also be a tax event. So just please be aware of it. Thank you for watching or for listening. And please, it really helps me if you press the like button. And if you want more content like this, I will be keeping all this sort of thing up to date. Then please consider subscribing to the channel. Thank you.